Good morning, everyone. This is Glenn Thompson, and welcome to today's presentation, Let Bonds Lead the Way. Just to make sure, did a little quick check about 3 minutes ago. Can we still see and hear the presentation? Great. Thank you, Earl, and welcome, everyone. I just hit the recording button, so we are recording today's presentation in case you'd like to review or if you come in late. Excellent. Thank you, Steve, I guess. All right. As you see on the screen, I've been working as a mentor for a long time now, almost 16 years at Pacific Trading Academy. You can contact us 800-339-8588. You can also take a look at the website www.pacifictradingacademy.com. If you have any greater interest in finding out more about the details of some of the programs concerning what I do and what some of my coworkers do, talk to Peter Newman. He handles all of the admissions and internal arrangements and can oftentimes put you in contact with me if you'd like more details as well. Let Bonds Lead the Way was the title I chose for today. A lot of things going on, obviously, fundamentally, news-wise, day by day. I guess I last had a presentation maybe about 3 weeks ago, I recall, and at the end of the presentation someone said, do I anticipate there will continue to be events in the world that will impute the same level of volatility into the financial markets? And I wasn't sure if they were joking or not, but certainly that has proved to be the case. I thought last year was going to be the year, 2015, of volatility. It seems upward and onward. We're seeing increased amounts of events and the frequency of very intense events that serve to continue to create motion and opportunities in the markets. There's a lot of confusion in terms of trying to figure this out and locate very good trades. So I always maintain follow the money, and certainly that applies. That's not purely speaking a technical approach, but I think it's a good one. So let's begin. Let me hit the slide presentation. Timing should always take precedence over price. Just those of you who've listened to previous presentations know that the correlation with time and price for me is a driver and an initial starting point. Specifically, I look at certain time periods that I believe after they've elapsed correlate clearly with certain turning points in financial markets. And I don't complete an analysis based on certain time periods, but certain cyclical components and their corresponding correlations with certain markets I believe give me significant edge in terms of locating good entry points. Money flows towards the greatest rates of return, and thus essentially the bond market is an indirect way at looking at the cost of money. So depending on where money perceives or capital perceives its greatest return shall be or could be, is where it's going to end up flowing. So to some extent that often provides added clarity in terms of how you can expect a different sector or instrument will behave, and that's a starting point. So from a cyclical standpoint, that's really enabling us to get a handle on certain time periods that correlate with good trades or good turning points or changes in a market's motion, along with considering how the dollars and cents, the money is flowing. Often these things brought together will point out good opportunities, at least in a global sense. Daily bond chart. We have a specific opportunity, I believe, right now. Earlier in the week, about 3 days ago, 3 sessions, I shorted the bond market. This is a chart, a daily chart of the 30-year Treasury, 30-year futures on the 30-year Treasury bond. And I did so in combination or in response to a combination of factors. Let's see, can you guys see the pointer here at the top? All right, hopefully you can see I don't have the dates marked on this chart, but this top, I believe, corresponds with the end of a wave 5. Let me stop right there. Again, those of you who have listened to me speak over the last 2.5 years, I guess I've been doing webinars for that long, know that one of the modalities, a descriptive model that I incorporate, is Elliott wave. It's pretty, well, here's I believe the top here in the bond price, the 30-year Treasury bond, corresponds, I believe, to the end of a fifth wave. So for example, this little peak here in May, I believe, is the end of a first wave, an initial set of 5 waves going up, the bull phase of the market. This bottoming area, it's a little expanded bottom, is a correction wave 2. This is your wave 3. Your pullback here is your 4, and then up to the top is the 5. So I had, from the vantage point of the wave principle, factors suggesting a turnaround in nominal bond prices. This correlates with an expectation, if not an actual, increase in the cost of money or interest rates. So that brings into the fold the possibility of a reconciliation between a fundamental component, that is central bank or monetary policy, in conjunction with the technical. And that's what you're looking to do all the time in an effort to locate good trades. Confluence, convergence. When different types of information get into cahoots with each other, or with one another, or alongside each other and align, that typically improves on the continuum of odds, your probabilities for a good edge, and that you've located a trade. So what my thinking is here, when I saw this structure on a daily chart, again, this is a textbook formation of a set of 5 waves, the bull portion of an 8-wave cycle. 1, 2, 3, 4, and then up to the top. And there's the internal substructure that's consistent with the tenets of the model as well. The point of today's presentation, again, is not to get into detail on any one of these points, but to point out in a global sense why I expect certain types of price action and where we can profit. So if this top here, this high black candle up here, corresponds to the end of a 5th wave, it marks the start of the bear portion of an 8-wave Elliott wave cycle, the ABC. And so far we're seeing price action reflecting the projections that the model indicates. The question is now, is this the entire move down? Is this the ABC, or is it just the A of an ABC? Is it just the first leg of a 3-wave pattern that's predicted by the model? I expect it's just the beginning first wave, and I'll explain why in subsequent slides. All right. And we have our little cartoon figure pointing out up, up, and away. And so the first part of, we've seen that. So what goes up must come down. All right. Very good. Moving on. I can hit the. Okay. Here is a very important aspect. I just want to provide, excuse me, an added indication as to why, from a time standpoint, I expect there to be further declines in nominal bond prices. So the question is, if this top here on the bond chart corresponds to the end of the 5th wave, it's anytime a tentative Elliott wave is that once markets reach the terminal point of a 5th wave, it will reverse in order to form the ABC bear component, the bear market, the period of time where the market's coming down. So if one of the things I thought about is if we have a handle, if I can project with some degree of reliability the run time, how long can I expect the market to remain in its bear phase? That gives me significant edge. Price projections and price targeting is typically an easier type of information to procure versus time. Knowing how long a market is going to be in a particular type of orbit or type of behavior usually is a little more involved than projecting or working out or forecasting the degree or the change in the level of the system. How long a certain type of price behavior maintains or runs is, as a complement at least to affecting an effective price target, will give you significant edge. So my idea was has been for the last week or so, to try and figure out how long I expect the market will remain in the bear component or phase of its cycle before it starts another cycle to the up, taking the price to a higher point. So we've got this top up here, which I believe from a wave count standpoint corresponds to the end of a fifth, and as such I would expect falling prices. And so far for the last what is this, 6 sessions, 1, 2, 3, 4, 5 days from the top, we've been declining. So the question is, how long do I expect this falling further offering of nominal bond prices to continue? And I want to figure that out by any means I have. So, thus the next slide. This is an indirect way by which I'm trying to arrive at a sense as to the runtime for which I expect the market to decline. One of the tenets of Elliott wave is that the set of 8 waves that comprise a given cycle duplicates or replicates itself. This is what's known as the fractal property of the Elliott principle. And again, I don't want to get into too much detail, but it is helpful to understand that a fractal property, or something which is fractal, an object or a system, in the case of financial markets, stocks, commodities, bonds, you name it, any freely traded market, is self-similar, meaning that you will see the previous pattern. This is textbook. This could be in a presentation of Elliott wave. This is wave 1 going up, 2, 3, 4, 5. You see the clear number of inflections corresponding to a set of 5 waves, the net translation of price of which is to take the market to a higher level from where it was back here in May. All right, that's a set of 5 waves. Then you have an A wave coming down, a B wave ostensibly would be rising, and then a C would take it down. And that set of 8 waves would constitute one cycle, and then effectively the repetition factor is what accounts for moving or pushing a market forward and maintaining its perpetual motion, I guess, forward through time. All right, so again, how can I forecast? Where do I expect that this cycle will end? Well, you will see this pattern of 8 waves, the 5 of which we're showing here, or 5 or 6 possibly, or 5 and a fraction. I don't know perfectly well at this point in time whether or not this first leg down is complete, or if in fact maybe that's the entire ABC, just the resolution on the daily chart is maybe not high enough to indicate that there are in fact 3 waves. But assuming for the moment it's just a single leg or a wave, that would mean that there are 6 waves, or at least 5 and a fraction, almost 6. 1, 2, 3, 4, 5, corresponding, marked off or bounded by the tops and bottoms respectively, let's just say. All right, so this pattern, the fractal property of this set of waves, indicates that you will see market by market, trade by trade, system by system, regardless of what time frame you're on, and it more or less correlates to the time frame of your chart. This pattern, but you'll see smaller versions of it, you'll see larger versions of it, and more or less the shape and structure and spatial and angular relationships remain pretty much the same or constant. And when a system or an object, in this case, if I consider this snapshot, the screenshot of the chart of the history of the market as a stationary object for the moment, just for ease of understanding, you will see that particular structure, but you'll see it manifest under different circumstances for different markets at different times on different charts in different sizes or levels of observation or magnitudes. You'll see smaller versions of it and you'll see larger versions of it, but it'll look pretty much the same, if not perfectly. And when an object has that property, that's what's called being fractal, or that's the fractal property, i.e. the self-similarity of structure of the thing you're studying. In this case, it's the graphic illustration of a market's history. All right. Well, it turns out that we've kind of defined that a little more precisely. When Elliott came out with this idea back in the late 30s, early 40s, he basically defined 9 definitive or definite degrees or levels or sizes. For my purpose and for most traders' purpose, there's what's called, I think the largest at the time back in the early 1940s was the grand supercycle, and it's on an order, and 1 degree or level of observation, each degree or level of observation is distinguished from another by virtue of time. In other words, the larger the degree, the more time it takes to complete. The smaller the degree, the shorter the window of time. That's all. So a grand super cycle, I think, might be something on the order of like 25,000 years. Okay, so not immediately of any great importance other than for some specialized research purposes, let's say. My primary degree is the one that I usually utilize as a backdrop of starting reference, and it's roughly plus or minus 4 years. Kind of interestingly enough, almost coincident with the 4-year presidential cycle here in the United States. Okay, so primary degree is 4 years. You might say, well, two of them happen, 2 years for the bull phase, the 5 waves taking the market up, and then the other 2 for the bear market. It doesn't work out even, but on average you could break it up 50-50 like that. So the primary degree is a particular degree of set of waves which would tend to play out over that runtime, about approximately 4 years, plus or minus. The next smaller degree is intermediate degree, you see, and then so on and so forth. Minor is primary degree, intermediate degree, minor, I think it's minute or minuet, or minute, and then minuet and subminuet on down. Now they've got additional degrees. I think they're a total now of about 15 degrees. You can get it down to like the micro, the nano, the sub-nano, down to like the duration of maybe a minute or 60 seconds or something. So if you're a day trader, the micro or the nano or the sub-nano degree, where you're on the time window, each set of 8 waves would play out over a period of roughly of approximately a minute, all the way up to what might be, and I think now on the upper side, on the larger degree, there's like cycles or degrees larger than the grand supercycle. There might be one like 125,000 years or something. And so if we're talking about planetary or celestial cycles and cyclical components of our galaxy, that might come into play. But for the most part, again, unless you're talking about portfolio management and holding a set of stocks for a long-term investment over 15 to 25 years, the primary degree for trading purposes, in and out, my average day in a trade, a long hedge position might be a year. That would be the longest. I tend to be in and out as a position trader, maybe for a period of a few weeks to months. But this gives us some backdrop of context of understanding. So the idea is, in a primary degree, what by definition this means, assuming it lasts roughly 4 years, let's say, you have the set of 8 waves, 1, 2, 3, 4, 5, taking the price action to a higher level from a base of support, and then you have the ABC. The nomenclature of the model is such that the first 5 waves are labeled with numbers, and then the final 3 with the letters ABC. So a total of 8 waves constituting one cycle. If it's of the primary degree, it should last 4 years, and in that period of time you have a total of 8 waves. And so this scaling component, where you have the smaller embedded structure that's similar in appearance and shape and angular and spatial relationships in all respect, it's just a smaller scale version. Say if you shift down or drill down 1 degree to the next smaller level, known as the intermediate degree, there are 34 waves. In other words, there's a higher resolution, and so you split up each of these waves in certain specific ways as indicated by the model, such that it works out that there are 34 waves. So what is that saying? That's telling us that in this degree, if you are in this so-called degree of observation, that over a period of 4 years, the resolution is higher than it is in the primary degree to the point specifically, so you would expect about 34 waves to occur in that same period of time. And then you can take it down further. Minor degree, you'd have 144 waves. So essentially, as an analyst, trying to find where you expect a market is relative to its 8-wave cycle, depending on the amount of detail and what you're trying to do, you could isolate, and this is a way of doing your so-called wave counts, isolate the number of waves that would be congruent and expected to form out over this period of 4 years, if the primary degree level of observation is your starting point of reference, you see. Okay, so again, what we're trying to do analytically here is I want to figure out, so I can figure out what the forecast for the bonds is. I want to figure out what its runtime is. How long do I expect this market to stay in this bear phase? If this top up again, up here at the top of the chart, if that is in fact the end of a fifth wave, the end of the the bull portion of the market cycle. And I've got 5 waves occurring in this period of time here. And how long would I expect the bear market component to last? If I have some indication in my thinking, if I have clarity on how long I would expect a given market to stay moving with a particular type of behavior, that gives me at least some indication. I'm better able to conjecture how far, and from a price vantage point, it might travel. And as such, do I have, from a reward risk standpoint, a good setup for a good entry, a good trade? Does it make sense? The greater the amount of time a market has to travel from point A to point B, the greater opportunity it has to move a greater distance. It's not it clearly is not directly proportional in a perfect sense because of the nonlinear types of motion that are interspersed with linear. Market price action is not purely linear. There's a hybridization between linear and nonlinear type of price action. But more or less, in an obvious sense, the greater time for a run, the greater opportunity for a market to travel a greater distance. The less time a system has to move with a certain type of trend, let's say up, down, or sideways, the less distance potentially it could travel, assuming some amount of linear response or relationship between time and price. Okay. So here's what I did after taking into account the number of waves. So let me just cut through the chase here. I believe that this chart right here, starting with this bottom here in May, right around the first week of May, up to the top, if that's wave 1, the pullback, correction wave 2, and the next impulsive wave 3, 4, and 5. That set of 5 waves, and then what appears to either be the A of an ABC, the start of a bear market component of the cycle, the final 3 waves. The amount of time that it's taken for the 5 plus, if not 6, 5 and a fraction waves, let's say, or 6 waves, is consistent with the minor degree of observation. In other words, I would expect the amount of time, within a 4-year span, let's say, if I were to look at it, the set of waves as depicted in the previous slide on the daily chart for the 30-year Treasury, I consider to be minor waves. Why? Here, 4 years, if you have over a 4-year span, okay, and you have 8 waves, well, that roughly just divide, that's 4 years is equal to, just some simple changing of the terms here. 4 years is the same thing as 208 weeks. Well, if in that period of time, I should expect 8 waves on average. Now let me stop, this is a big assumption. Anyone who understands Elliott knows that each of the duration of each of the waves is not uniform. It's not symmetric, clearly. Fourth waves, we know, clearly tend on average to take inordinate amounts of time off the clock versus wave 3s, which are explosive and higher velocity. But you have to start with the simple, just to give I wanted to present a bigger picture of what I did here. So if you have in a period of 208 weeks, if you can expect, you need to see, for a complete cycle to form, 8 waves, that would on average say that each wave is approximately 26 weeks. Okay, this will enable a finer, more objective, rigorous selection of a particular wave counter description versus alternate descriptions that may not be as appropriate and valid an explanation for what's occurring. Okay, so if I'm looking at the primary degree, I would expect the 8 waves to form more or less in a period of roughly 4 years, plus or minus, and as such, each wave would on average run for about 26 weeks. If I'm interested in the intermediate degree, I know that 34 waves should form over that same 4-year period. As such, 34 into 208, average run time for each of the waves would be approximately 6 weeks. If I expect and am interested in the minor degree of resolution of waves formation, 144 into 208 works out to approximately 1.4 weeks for each wave to form, the amount of time, or that translates to 9.8 days, almost roughly, you could round it up if I chose to the next even digit to 10 days. So Go back to the chart, and we'll come back to this. What is each? I count the amount of time. That's, by the way, I worked backwards to count, and I can average, as we'll see in a later slide. That's why I felt confident that the set of 5 and a fraction or 6 waves here, from this bottom in May through where we are, this is as of the close yesterday, July 15th, is a set of 5 waves possible, and then ultimately to form the final 3 waves comprising the complete cycle of the minor scale. Okay. And so roughly I can expect on average, I got to emphasize that. Clearly there's not a democracy of equal time for each of the waves. But on average, as a very gross starting point of trying to figure out what's at work here and what's causing the market to move, I can expect the average run time for each of these moves or waves in an 8-wave cycle to last roughly just under 10 days. Okay. So that's going to help us figure out where the market is and where and how we can expect it to go, and as such determine whether or not we have appropriate conditions for a signal for entry. All right. Okay, so everything I just said in the previous slide had to do with me figuring out from a wave standpoint where the Treasury bond instrument is, and inversely what I expect Fed, monetary or interest rate changes will be. All right, how does this impact the U.S. dollar? This is the chart of the daily dollar index, and you can see wave structure here. If starting at the very bottom of the screen, if that's the start of an impulsive bull market cycle, a wave 1, I see an inflection point right here, right at the end of May, beginning of June, corresponding to the end of wave 1. The pullback here, I see the 3 little divisions corresponding to what we would expect in a wave 2, for those of you who understand wave analysis. Look at how the market took off. That's a classic wave 3. And look at the sideways consolidation for the last, what is that, 2.5 weeks here. That's 4th wave. As such, again, for those of you who are aficionados and understand the Elliott principle, you might be guessing just on this alone. I'm simplifying because we have to put things together here. I would be expecting further appreciation in the U.S. currency if I'm only taking into account what this screen shows. You see, this yellow line, if you can see that, the date here is what's important, August 3. So the first week of August, I have a turn. That's a turning point. These 2 lines, these vertical lines, this one is further out. I've already projected for it when I can know the market will turn based on my time projection analysis further out into the fall. But more of immediate concern, my next projected time point for the U.S. currency is coming in on August 3. So what is that, about 2.5, 3 weeks, whatever it is from today, whatever. So is it one of 2 things I might expect by projecting my time point, that is what I was indicating relevant to the Treasury bond instrument, to the extent, and this is generally applicable across the board, all markets, the more sense and clarity you have as to how long you can expect the run time is for a market, you can reconcile that with your price analysis, which is something like what the Elliott model is good for, trying to figure out from the vantage and perspective of price what's going on. Couple that with the timing. If you have a sense of runtime, you can see if some of these things reconcile and line up. And if they do, you're on stronger probabilistic footing or ground, if you will, and you have greater edge, I submit, in terms of your trading. So we know that 4th waves take a lot of time, if you know that. But either I would expect one of 2 things, just technically, without taking into account anything going on in the world and the interactions and the interplay and the reverberations from what's going on in another currency or another nation's sovereign state. All I can see is technically on the chart. I know I can clearly see a price action consistent with 4th wave type structure, and I have this 8-3 time point. Might it be that I might expect this market to continue sideways for the next 2 or 3 weeks? Into this point and then end wave 4 and embark on a breakout in what would be wave 5? That's one possible scenario, clearly. An alternate scenario is that maybe there's a breakout point that my radar of analysis has not been sensitive to. It hasn't picked it up, and it's going to break out prior to August 3 at any moment. I might draw a trend line connecting these tops as a zone of price resistance, and then utilize that as a threat, as an acid test for whether or not I should establish a long position in what would be the formation of wave 5, an impulsive 5th wave, in my wave on that wave count, let's say. And possibly that, if that were to occur, I might surmise that this August 3 would correspond to the end of the fifth wave. And then I'd be looking to go short with an expectation I might have the run time through this next projected time point out in October. I'm overly simplifying, but you get the point, I guess. Okay. Let me stop right there, folks. Any questions so far? Am I still loud and clear? All right. Great. Earl? All right. You with me, folks? Everyone? Hopefully you're there. Good. Thank you, Steve, or STU. Okay. Now, so adding just one more layer. Thank you, Earl. Okay. Adding one more layer of different information to what the technicals indicated. People, you know why fundamental analysis is so it's so accessible, because we are, as humans first, before we're investors and traders, we're humans, and we're bombarded in 2016 with all types of information 24/7. The problem we have of analysis and trying to locate good trades today in 2016 is kind of like the polar opposite of what was going on 100 years ago in the early 1900s. Back then, every information was moving at a snail's pace. They didn't even have Pokemon Go. They didn't have silicon-based ideologies and technologies. The cell phone or a smart device or a smartphone was not heard of. They were communicating by, I don't know, depending on what year, 1910, 1915, telex, telegraph, writing a letter. The transit time of information, you had to take there was no transatlantic cable to communicate. Literally, information could take weeks, months, years. So everything was at a snail's pace, and that was a problem. Today, news equals history. That's a running joke. Even when I started in this industry 34 years ago as a broker, we used to, with senior brokers, when I got started, I would hear people in my office say, oh, someone's trading off the news. Well, good luck. That's history. And that's even 20, 30 years ago. We'll look at where we are today. It's really a problem analytically of signal-noise ratio, trying to figure out and separate amidst the detritus that's out there, all of the white noise, if you will, what is meaningful, meaningful from the vantage point of giving you edge, enabling you to see versus the trader on your left and the trader on your right, what's going to give you some advantage. What is it that you can see that the trader who lives across the street from you, around the world from you, doesn't? As such, you have a definitive edge when you place an order in a way that is unknown to your cohorts in the market, because that's really what it's about. But anyway, here's my point. I don't want to get too far off on a tangent. If this is a chart technically, and I'm expecting at any point a breakout, and because my models tell me a fifth wave is going to form, and I know if structurally what that means, it implies that we should have appreciation in the nominal price of the U.S. currency. I could infer what types of events fundamentally might be supportive of that. Will the Fed raise interest rates? If so, when? That's a big question that we've been concerned and tossing around and thinking about from the beginning of the year and even further. We had, I think, the last time the Fed had a 25 basis rate hike in December. They were, and then month after month, about a week ago, last Friday, not yesterday, a week ago yesterday, they had a relatively strong, quote unquote, employment or unemployment, whatever they call it. Yesterday they had a nice retail sales report. So the question is, are we seeing enough? Again, I'm talking, I've shifted gears from the chart. I'm leaving that and taking it and want to consider for a moment some fundamental factors. Why? The information is information, be it fundamental, technical, quantitative. Cyclical analysis, that is trying to project time periods, and time periods that are correlated with changes or, let's say, trend reversals in a financial market. What type of analysis is that? It doesn't fit into a nice, neat label category. It's kind of quasi or semi-technical. It's not purely technical because it's not coming straight from the price, but it's not as if I'm examining a company's balance sheet and insider trading and all this stuff. It's not, I'm not looking at supply-demand data directly, so it's not purely fundamental. It's in a gray area. Who cares? Technical, quantitative, fundamental, it's all information. So the key idea to ramp up your chances for consistent profits is to find scenarios where all these different varied spectrum of types of information align and coalesce in what we call cluster. A time cluster, a price cluster, a time price cluster, an information cluster. The more clustering or alignments you can get of different things, the greater your odds are you're going to wage a successful, profitable campaign. So if, you know, that would, this chart alone would suggest to me, I'm not saying I'm going to sell, it's definitive in making up an investment decision, but it does suggest sooner in a vacuum than later I would expect the Fed to have another rate hike. So when people ask me, what do I expect, you know, when we're talking on the level of fundamentals, I would say this chart technically, any and all types of events that would be consistent and reinforce the concept of a probable breakout of further appreciation in the US dollar, I would expect, and I will not be surprised. Does that guarantee the Fed's going to raise rates next week? No. But it is, that would be a type of factor, if it is, let's say, that would be consistent with what the technical price analysis and time analysis are indicating. So to some extent it gives me, at least it puts me in the probable, it enables me to direct my rangefinder in a probable, towards the probable ballpark of types of events I can expect. All right. I also, now I might, and just further adding, you know, I know that I've been telling the traders and people that I consult in sessions of instruction through PTA for weeks now. I expect, historically, just my awareness of how the central bank tends to operate, they tend to refrain from major adjustments around major political events, such as a presidential election coming up in the fall. So if they are inclined to raise interest rates, I would expect it's more likely going to be either one of two things: prior to the end of, you know, by the end of the summer, as before we move into too proximal a time point close to the presidential election. If not, then I think they'll leave hands off all other pieces of information, apart until the end of the year, December. So it kind of gives me a sense as to what I can expect monetary intervention-wise from the Fed, let's say. All right. So we have a potential scenario here based on monetary flow and the corresponding technical and fundamental considerations I feel are tantamount to giving an indication of probable trajectory for this market. Move on. That's a trade. And the specifics of how you would do it: do you trade the futures? Do you buy call options? Do you do a spread? Do you do an ETF? Those are particular to your style and dollar amount, and the particulars that differentiate your account and what you like to do, and also your objectives and your tolerances, etc. Those are the things that in detail each investor has to work out. I'm just talking in very broad global terms as to an opportunity. Here, you also would take into account, certainly with a currency, price action and the impact and corresponding other currencies from the Forex perspective, let's say. All right. Yep. Okay, next slide. This is a recent trade I did. Certainly Brexit, the aftermath of Brexit, what's going on in China, all the, certainly in the last few weeks we have seen a rise in the intensity of often calamitous, egregious, weaponry and attacks all over the world. ISIS, all of these things. So this chart is a daily chart of the British pound, US dollar, Forex currency pair. It's the daily chart. Let me just, and clearly this big move here is the decline in the value of British pound relative to US dollar. I'm not sure. I was thinking intuitively, I don't know why I had that so low on the screen. I was trying to pull my down. I realized this is a screenshot. But here's from trying to make sense of a fundamental event that if you weren't looking and paying attention, it might have caught you off guard. Obviously, those of us who are investors and following the news leading up way in advance of Brexit and the referendum back in Europe a few weeks ago would have been ready for something. You may or may not have been expecting such a big move, a multi-sigma event in such a relatively short period of time. Well, one of the things that Elliott wave does is put this into in a context that makes sense of what might otherwise seem chaotic and completely inexplicable. Here now, for those of you who really know Elliott, I'm taking some liberties. This is a 1, the start of a 1. Here's the end of 1, and this is 2. So I just broke a rule there for those of you who know what I'm talking about. I don't want you to think I'm taking liberties with a model. But I am, for a good reason. That's a technical point. I'm not trying, that's not the point here. Suffice it to say, forgetting that wave count for the moment, this free fall, that's classic wave 3 action. That's Brexit. That was the response to Brexit. And I remember, clearly, I had projected a time point. I was 2 days before. We were long the market here, and 2 days, and I had a time point that came in 2 days in advance, kind of around, if you can see that candle here. So I had the right idea. I was just a little early on my projection for a turnaround. I had no idea. In fact, I was thinking the week before the vote in Great Britain, I thought that I got it wrong in terms of the vote. I was expecting that they would remain a part of the Union, and we would see further a move in the opposite direction, similar possibly, but just a skyrocketing upward. But what I did get right, at least to some extent, the thrust of the idea was to project a turning point, and it did a change in the price, a time target, and I was just expecting that it would manifest as an acceleration to the upside, not an absolute reversal as we saw. But in any case, this is wave 3. You had 3 or 4 days of reversal, the very shallow wave 4, and then your 5th wave. So the point I want to make by this slide is you have an adherence, even in the midst of a very large, from an energetic vantage point, a very huge global event that we are still experiencing even in a declining manner, the aftershock, global capital market aftershock. Still, it was such an event, a big event, but even in spite of the abruptness of it, Elliott wave very adequately defines and organizes and puts into a context that's understandable what took place. Even if after the fact, one of the critiques of the Elliott model is that it enables you to see everything that's going on, but too late. It's a specious critique, if you ask me, because as a descriptive model, even to the extent it doesn't forecast exactly how a financial system or market is going to move into the future, it can at minimum sometimes often give you confidence that your description of the present state of the market is accurate, and as such that gives you confidence as to knowing how the model works. It gives you confidence in what you can expect how a given market will move. So I said all that because we did a recent trade. My last trade I actually did as a short-term position. I'm in some long-term plays right now as we speak, but just 2 days, well, yesterday morning from 12:30 or so, I shorted the British pound. This is the daily chart here, the next screen. This is part of the reason why. This is an hourly chart, same market, this is GBP USD, British pound cable, or British pound USD, currency pair, forex pair. This is wave 1, 2. I've highlighted with the trend lines to delineate the structure, make sense of it for those of you who are maybe getting started. This is a wave 3 up here. This is a 5th wave. These two lines, these little angular triangular lines, are a particular graphical or geometric technique I utilize to generate and project when a market's going to turn. The intersection of these two lines generated, I had done that. Once these 2 points had formed, I was able way in advance to project this, before all these candles had formed. I didn't know it was going to be a top or a bottom. I had an idea based on the wave pattern. So here I have one modality, a descriptive price act model, i.e. Elliott wave, enabling me to forecast to some extent how I can expect or where I would expect in price to go. The timing was a consequence of the intersection of these two lines based on a particular technique I employ. Notice I didn't quite catch the top. It was off by 2 candles. This is an hourly chart, so I was off by about maybe 2 hours. But I had the right idea. And also because I knew from a Fibonacci standpoint that this top was corresponding to the 5th wave, I had the idea to go short. I didn't, and so look what happened. So we got short somewhere, I don't remember, but somewhere in here, these little lines, and I projected that this was, once the market started moving down, this was a wave 1. You had a little pullback I saw that was rather deep. That's a wave 2. And then I had a price target of wave 3. This was one of the better trades I've done in a while from the standpoint of getting out close to the end. I'm not boasting in the slightest. I'm saying I'm giving credence to the idea that in this case, the intraday activity of the GBP USD was very sensitive to the Fibonacci 161 ratio, if that was in fact a wave 3, which I think of the particular degree it was. And then notice you had their fourth wave, and we are getting started coming into the close before the market closed for the weekend. This little candle here, this little hanging man type structure, is the initial phase of what I believe is a fifth wave. I'm not saying for you, if you're a beginning trader, I'm not saying, if you're following me, don't mean necessarily go short, but you could. That's because, you know, over the weekends, I might start with a clean slate from a day trading perspective. But you see textbook structure. The top here, the end of a fifth, 1, 2, 3, that's classic third wave, corresponding the shadow of that candle right into the 1.61. That's textbook wave 3. You're very shallow retracement wave 4, less than 38. That's not even 38%. And then the truncated wave 5th, if that in fact is a complete wave 5, or maybe it's just the start and we ran out of time coming into the weekend. So what I'm showing here, that's just so even in the aftermath of Brexit, there are opportunities to play off of and locate structure if you can find good time relationships and price relationships. Even as we move further and further away from the event itself, i.e. Brexit, and I can expect that there will at some point be diminishing correlated memory impact from the event to the current price changes and returns we observe. All right. Soybeans, completely different market, and how in the world does that, what does that have to do? This is an agricultural commodity. This is a daily chart of January 2017 bean chart, soybeans. What does this have to do with the US dollar and interest rates and the bond market? Well, curiously, there is a very well ingrained, deep level correlation between inflation and nominal bean prices. Don't try and cause and effect are not what I'm referring to. I'm talking about numerical correlation. As bean prices rise, you can expect rises in GDP and inflation. As they fall, they're directly related, more not perfectly, but more or less directly correlated. Here was a recent, I actually did not do this trade. I sent it out, or I talked to some people I consult, and in combination with a few things. But notice you have some nice 5-wave structure. One of these tops in here could be interpreted as a wave 1. Your bottom is your wave 2. This is your wave 3. This peak right in here between kind of right first week or so, or first part of May, is the end of wave 3 up at the top. You have a very shallow pullback corresponding to the formation of your correction wave 4, and then up to the highest point is your 5th wave. Now, right around that time, that 5th wave, someone informed me there was a crop report. We had extreme excess supply relative to demand. It was the point of the report, and as such I was expecting a decline in nominal bean prices, which we saw. And I missed that part of the move, the initial phase. I knew that the report was coming. I saw the structure. So we have a cluster of different types of information, i.e. a grain report or a crop report, consistent with the idea, with the expectation and projections being that we would have excess supply relative to demand. I'm simplifying, but that was the essence of the report that came out. And I was aware of that projection for that report. And I was also aware of the price action, and my interpretation of this was that it was nearing or at the end of the 5th wave, or nearing such if it wasn't actually there. Here you have a series of waves coming down. If you didn't catch the first one, you had the 2 Fibonacci levels, which if you're informed, you know that these are the 78.6 is what's known as a Gartley. So for you had a second chance if you didn't capture the first wave down. You had the perfect retracement to almost a perfect 78.6, which is a Gartley, and look what happened. So I merely inject this slide, or brought this slide into the presentation to illustrate the interplay of bean return behavior, the price returns in soybeans, as an indicator very much directly correlated with inflation. So to the extent, and how does that relate with expectations of of the central bank in the U.S., the Fed in the U.S. and other banks in Europe, your ECB and BOJ, etc. So we want to take this into account. There may be in varying sectors, north, south, east, west, opportunities. This, if you're not in the agricultural derivative markets, that you can still utilize this as an indirect indicator of what we might expect with interest rates and monetary policy and some of the financial sectors like the stock market or individual stocks. Whatever your instrument, there are correlations that we want to pay attention to. All right. Fourth wave pennant. So everything I've just mentioned, I'm currently short the bonds, and I'll talk about that in a subsequent slide in terms of opportunities going forward. Next trade, possibly next week, on the imminent kind of analytical horizon, as it were. This is silver. For those of you who follow precious metal evolution and motion, gold, silver, platinum in particular. This is a daily chart of the September silver futures contract. For those who trade ETFs, things like SLV, I guess, and GLD, and there's another one for platinum. I would stay away from platinum based on the liquidity, and it's less liquid, but I tend to trade silver because it tends to be of greater volatility than gold, but either one is appropriate. They're 70% or so correlated, gold and silver in general. This is a daily chart of silver. We were long silver for just about 2 weeks ago, and it had a very, this is, what I consider to be a wave 3. Let's, again, you have, say, you pick one of these bottoms as a starting point of a 8-wave cycle, 1 up here to the top, right at the first week or end of April, beginning of May. That's the end of a first impulsive wave 1, correction wave 2 down into, what is that, the end of May or actually June, I guess, whatever that point in time is. And then you had a kind of a skyrocketing wave 3, classic wave 3. And we were able to capture some of that move. If you're not in it right now and you'd like to, what do we have here in the last 2 weeks of price action? Little consolidation. Everything, if you look at the highest point on the screen, which I submit based on Elliott principle, is the end, corresponds to the end of a wave 3. If you look at the price action to the right of it, all of it more or less is very choppy. That's classic fourth wave. Very classic fourth wave. Essentially the market's at the same level, more or less. You see, the silver price on the futures closed yesterday at about $20.16 per ounce. So, what I'm expecting, if on the, I'll put the market to an ultimate acid test. Price always rules the day. Even though on an earlier slide I mentioned that I utilize and depend on, from a cause and effect standpoint, time, and I really believe that. It's a close second to me. Price is the ultimate indicator. It is the reality. So, it's the standard. So, here's a little triangular pattern. Triangles occur most frequently in the fourth wave portion of an 8-wave cycle. The greatest the highest frequency of location for triangular type structures is in wave number 4. The second largest or highest frequency is in the B wave of a larger corrective pattern, but that's a separate issue. What we clearly see here is a fourth wave. I had planned, and I was messing around with this last night, I was going to show you an intraday chart, an hourly chart of this triangle to show you the 5 or 4 and a fraction waves. A, B, C, D, and E is the way in which you can expect a triangular correction to form. And I was just going to show more detail. For about an hour, I played with the chart, and I had all sorts of technical problems, and I finally just said had to go to bed. So suffice it to say, this is a triangle, and it tends to have a high correlation with when the triangle completes, which, by the way, should be prior to the apex, prior to the tip of the triangular, the two sides of the triangle. The triangle together with the post constitute what technicians or classical chart patterns refer to as a pennant. But suffice, either way, it tends to highly correlate 75% of the time with the market breaking out in the direction of the trend that the trend was moving prior to the formation of the triangular structure, which in this case is certainly bullish. So my condition for entry, I told a few people earlier this week, if you're very aggressive, go long now. Or if you're already long, add to your existing long. If you're more conservative, require the market take out the zone of resistance. An obvious level or way to delineate or anticipate overhead resistance is just to require, say, a close above that upper side of the triangle here. And so that's a trade so yes, a specificity of signal might be on a close or a trading through, depending on how aggressive or how much money the specific strategy should reflect your account particulars and who you are as a trader. But in principle, in a broad sense, on a breakout of this upper side of the triangle, I'm going to establish or reestablish long positions in silver or SLV or some people are in the physical metal. However, there's many ways up the mountains and to play that pattern. But that's a trade I see on the near-term horizon. Okay. Moving on. This is a slide that I had. Any questions before I'm almost done? Very good, guys. Almost coming to the end, and I wrap up. All right. This was a slide I'd had in my presentation a few weeks ago. This is the daily chart of the S&P, and you can see it doesn't carry through yesterday. The final slide will, but I show some of the forecast I'd made in time. These vertical blue lines represent time projections that I'd made. June 22nd, July 7, and we have since passed them. This was I think about a week and a half prior to June 22nd. Well, as it turned out, I was 2 days. This is the stock market. 2 days ahead of Brexit. Brexit actually, the top in the stock market came in, or a top I should say, it wasn't the top, but a top occurred 2 days on the 24th, as you'll see in a subsequent slide, or if you're aware of what's going on, if you can look at a chart on your end. But I had projected, this was back there about a week and a half prior to June. It was kind of like, you can see where it is. If you can see the scale, you can kind of interpolate it, but more or less it was about a week and a half to 2 weeks before June 22nd, and I had projected that the market would turn. By the way, again, these dates don't in any way necessarily by themselves indicate, even if in fact in retrospect it turns out that it was a perfect reliable forecast. If the market turns right on that dime, right at that point in time, at the time you generate, or I generate, or the analysis comes up with these dates, the dates themselves don't in any way intrinsically indicate whether they're going to manifest as a top or a bottom. All they tell me is when I can expect a reversal in trend to occur. That's all it tells me, or some type of a shift in the behavior and characteristic attribute and features of behavior. Well, in this case, in retrospect, as you'll see, if you don't already, had the right idea. It was just 2 days early. It came in, I projected June 22nd. The actual top came in on June 24, and it was a top, if I recall. Yeah, you'll see on the chart. And then my next time point, 7-7, actually came in. It was a doji, and it was I think a day. It was like it was actually the point of a doji from a candle perspective is a point of equilibrium, and the very next day the market it shot up like a rocket, as you'll see on the charts. But this is the past, and very close high accuracy here. 2 days off in this case. Sometimes I'm perfect, but in this case the analysis was a little early on the 6/22. I was 2 days. The actual top in stock prices came in on the 24th, as I believe the next slide will show. And then on the 7/7 projection in time, I was more or less perfect. The market on 7/7, it manifested as a doji. Hopefully the resolution on the screen you'll be able to see. And it shot up like a rocket, and we got long. I was long. Well, we'll see. So that was then. And these dates, July 31st is my next projected turning point for the stock market, which, by the way, is a Sunday. So figure one and the same, 8/1, August 1. But precisely speaking, I get a confluence of my cyclical and all the different methodologies and models I utilize to generate time projections, center in on around 7/31. So figure one and the same as 8/1 for our purposes in a practical application. And I've already projected out to the fall in September 1920. I'm getting a lot of hits around the 19th and the 20th of September. So not of immediate interest to us, but it would enable me to conjecture at least the longer term projections. But for now, the next major one of immediate interest will be at the end of this month and first week of August. Say figure 8-1, since the 7/31 is a Sunday. All right, so next slide. So here's the same chart, but only through the September S&P through yesterday's close. And here's my next target. This is the August 1st, which is the 7/31 that the previous slide. Again, 7/31. This vertical line here is the next arriving time point, as I've indicated. And if you can see, here's, if I can find it, if I recall and I didn't mark them because I didn't want it to be too busy a chart, but this is the top. This big decline is Brexit. That's June 24. Here is the little, I forgot what kind of candle that is, but it's a little, whatever it is, I forgot. But I projected June 22nd as a turning point. We were going up, and we were close. Didn't quite get that at the top, but close. And then here is the doji. This is the July 7. And that was pretty much a dead-on accurate forecast. We've been long ever since. We got long here. Well, I'm essentially long from a few places, but 2074, and we closed yesterday in the September S&P at 2152 3/4. We've established new highs. I believe, as of 2 days ago, I didn't check the NASDAQ, but I believe the Dow and the S&P have established new highs with just last week's trade and activity. When I checked the market on Wednesday, I don't think the NASDAQ, I think it was catching up. It had not formed all-time highs, but I believe by Wednesday of this week, we had taken out the previous all-time highs, and we are now in new territory, at least for the S&P and the Dow. Now, I am guessing at the current velocity and trajectory, so too as the NASDAQ. I'm not certain on that, so don't quote me, but we have essentially moved up. So, August 1, this is the next time point for the stock market. I was telling people during the course of the week, some people were long via options, some in the July, and so maybe to take part, liquidate, and scale out of the positions. If you're not in the trade, if you're not already long from the lower levels, it would depend on whether, here all I can say is, again, to reemphasize, my expectation is that the trend that's in motion now will continue more or less unabated until and through August, the first week of August, into that first week, plus or minus. But that, precisely speaking, 7/31, which is the Sunday, and 8/1, which is the next day the market, it has a full session, August 1st. So it gives me a sense of how much potential on an assumption of embedded linearity. Now that is, granted, again, that's a big assumption. I don't know that at any point the market might stop going up. There may be a turning point that to which my radar and analysis was not sensitive, and this might correspond, August 1st might be a bottom. All I can do is take it day by day and interpret the information as each new candle and price bar is traced, or price bar is traced out on my screen with new information, update your forecast. But all things being equal, on an assumption of an embedded inertia, I might expect the market to continue moving higher into that point, and then a reversal into my next time point, which is out here in September 1920th point, you see. So it gives me a sense. That's basically, what, another 2 weeks and a few days, 2.5 weeks or so, of a projected run time for which the current type of behavior can be expected to move. All other variables fixed for the moment. So we have a tremendous opportunity. On this trade in particular, though, and then what we can do is incorporate any and everything else going on in the world. To the what might an impact if we saw a raise in interest rates? How would that impact the stock equity markets in the U.S.? Would it, all things being equal, rising cost of money puts pressure on stock prices and equities? You can be conspiratorial minded. To the extent, do we see the government in collusion with entities that can, if you're a conspiracy person, do you think the cabal that's, is propping up the market in light of, why is the market, I read an article last night, why is the stocks rising amidst all the terror and the intensity of calamitous events globally? One day after another, we have a coup in Turkey, we have terrorist attacks in India, we have shootings in the U.S., we have defaults here and there. We have one thing after another. It's no shortage of news and therefore no shortage of volatility. It's a heyday if I'm an options trader. But in any case, great opportunity if you're on the sidelines now, if you're in a position now, or if you're on the sidelines, certainly as we get more and more proximal to this point. If you're not in any position in the stock market, clearly every time you have a vertical line here, I have a tremendous opportunity for a high probability trade because of the correlated expectation for a change in the market's character on or about those points in time, assuming they are reliable. So I don't make my trading decisions solely based on time, but in conjunction, when I approach those time points, if I see a set of other factors, be it oscillator, candles, price, Elliott wave, Gartley, you name it, whatever is in your toolbox. So we've got tremendous opportunities here for significant returns. All right. This is just an elaboration. This is the bond market. This is our interest rate. This 30-year Treasury. Again, starting from this bottom at end of April, beginning of May, if that's the start of a set of 8 waves, an 8-wave cycle of the minor degree, and I'll explain why in the final slide. That's the coup de, I'm going to wrap it up in a moment, the next slide, I believe. 1, this is the pullback correction. 2, this is wave 3. Fibonacci, that's a very well formed. Actually, your 1.618 of 1 is up in here, but this makes it better. This fits with the subsequent price action. So this is 3, this is your 4, and then the top of the screen, this is a daily chart of the 30-year Treasury interest rate bond market. This is your 5 wave, and then this is the A wave or an ABC. I believe it's just the A for reasons that I'll explain. Here's this is the commitment of traders chart as indicated down below. Why? Another completely unrelated factor as to why I'm expecting further offering down of the nominal 30-year Treasury price. Notice this is just an accounting. The large specs are the green line, the blue line are the small specs, and the red line are the commercials. Notice that this is going back a year. Notice that the red line, the commercial activity, are just off of their largest net short position that they've been in for the entire year, going back through August of 2015. See a steady decline or increase, I should say, decline in the line, the level or nominal level of the line, but that reflects graphically an increase in their short position. And they are just, back about a month ago, they were at their largest net short. And right now they're still at, probably just close to, not just off of, again, the largest net short position for the entire year. Well, that's very bearish, excuse me. Notice as the market also, completely unrelated, I don't give as much weight to this, but notice from the top, what I'm calling the end of a 5th wave and the onset of the bear market phase of the market cycle, notice as the price has been declining, this lavender or purple line is going up. That's open interest. Well, that indicates the reason why the market's coming down is new selling as opposed to long liquidation. If I'm long, which hopefully you would have been going while the market was in the bull phase in wave 5, if not the previous impulsive portions of the cycle, if I see the market coming down, I'm eroding into the profits that the bull phase, the first 5 waves, generated. And so how do I get out of my long? I must sell, and that selling pressure is one that could tend to also push the price down. But that's a shorter lived phenomena than and so that's why I know that the majority of the reason why the market's declining from a open interest standpoint is not long liquidation. These are not traders getting out, exiting previously existing long positions because they're running for the hills for cover. They're getting burned or they're losing their profits. Alternatively, the reason the market's coming down in the net is new sellers, as reflected and indicated by this rising open interest line. And that tends to be a longer lasting phenomenon. That's another factor as to why that, coupled with the large degree of commercial net short position. And that's significant because they are accountable for anywhere between 70 and 80% of the activity, the volume. And to that extent, their activity, their trading becomes a fundamental, directly impacting future prices, and in this case, the bonds. So we've got a plethora, if you will, a number, there are some bullish factors here too as well. There's an argument that the Fed is going to, we may not see sooner rather than later an interest rate hike because of the strength in the U.S. dollar. Someone mentioned, I'm aware of that. There's the counter argument against that the Fed will want to raise rates to help out the financial sector, insurance companies, banks, etc. That improves their profit margins. Also, I'm not taking into account, but you should, to be complete, we have to look at any adjustments in monetary policy and interest rate levels relative to corresponding policy and levels of interest rates in Europe. In Germany, we're in negative rates. So we've got to see how that plays. Any adjustments we make, how does it impact trade and counterparty transactions and imports and exports and the balance of trade and the situation fundamentally between the European bloc and Asian bloc and so forth. So so that's a thin line, but those are fundamental considerations. But overall, even to the extent we see later rather than sooner a rise in rates, I expect for other reasons, technically and fundamentally and quantitative and timing, further declines in the nominal bond price. And as such, that's the trade of the week and possibly of the month. And the final slide will indicate from a timing standpoint, as it balances with price, my primary factor. Well, here's my time reason why I expect the bonds. And again, consistent with the first slide, when Gann said in the early 1900s, a market will do whatever it's going to do only when its time has come. So here I've clearly marked out just for, here's your wave 1 at the top. All of the waves are marked at the end of the wave. 1, 2, 3, 4, 5. And if I believe that is a 5, which I do, then by definition the market must decline. And we're beginning to see that. So the question is, again, for how long can I expect it to do so? And once I have a bead on or a sense of the runtime, I can begin to more precisely have confidence in my corresponding distance and price, my price projections. How much, and as such, do I have a good opportunity worthy of an entry? Okay, so here's my time point projected for the market based on everything all the models and tools and method things I do. July 29. 729 is very close to August 1st. The reason I mention that is because August 1st, remember from the previous slide, is my next time point, 731 for the stock market. It comes on a Sunday, so August 1. 729 is the prior Friday. One and the same thing if we discount the weekend, basically. That's not coincidence. That ought not be surprising. Clearly, stocks and bonds are highly correlated. They're an obvious, also from a capital flow standpoint. You could say the reason the stock market is surging, where does the money coming that's going from where does the funds emanate to push stock prices higher? It's got to come from somewhere. Matter is not, it just doesn't manifest out of nothing, unless it does. That's a separate issue. But yeah, I submit money that would otherwise be going into the bond sector to prop nominal bond prices up is leaving the bonds and being pushed into stocks. And that's why you continue, that's from that vantage point, capital flow standpoint, money follows the greatest rates of return, always, okay? So to the extent we see capital flows leaving bonds, offering the price down, it's going into the stock sector primarily. How long might this last? Well, my immediate time point, let's say July 29th, which is the Friday before the following Monday, which is August 1st. And so that gives me a sense as to how long I might expect the current modality or regime to last. So that, what are we talking? Another 2 weeks from yesterday, the 29th. I just looked at my calendar, 2 weeks from yesterday. The upper horizontal line indicates the level of potential support as indicated where the end of wave 3, historical resistance I can expect might act as some future support. The second lower line, the line below it, the horizontal, the parallel one directly below is an immediate conservative price target of about 170.50. This chart, folks, if you're paying attention, bonds are traded in 30 seconds. This chart happened to have, the software is doing it in increments of points on 100. So A 170.50 price for bonds is 170 in 16 30 seconds. It's one and the same thing if you translate. You would take the increment of 100 and divide it by 3.125 and you'll get the corresponding tick value for the bond. Okay, but that's an immediate conservative price target. If one, where do I think? People ask me all the time, where do I think a market's going to go? Well, a conservative price target immediately, but we've got to break, there is potential support at this level of just around 171 and change, basically, just above 171. But, and we're trading right now, we closed yesterday in the 30-year September bond contract 171.21, and that's based on the actual 30 seconds. 171.31. I got short at 172.20, I believe. I meant to short it sooner. I had some meetings, but anyway, I planned to go short at 175 based on my understanding and expectation or labeling of this as being a 5 and my time point. For various reasons, we got short at a lower level, 172.20 area, and we got some support coming in just above the 171. Depending on how the market negotiates the 171, my conservative immediate target, 170.16, is a price target for the bond. So if you're on the sidelines currently and you're trying to figure out, do we have a trade opportunity, just so you know, some of my analysis indicates conservatively we should get down to the 170.16 price area. My time point, my run time expectancy between now and the next 2 weeks, July 29. And or, you know, I could be off, so figure August 1st is one and the same when we especially take into account the correlation between stocks and bonds. Okay, here's something here's part of the other reason that corroborates why I have confidence in this. And in my further out removed, I just did this yesterday, my next time point beyond after we get into August is just quite coincidence, August 29, the end of August. That's coincidentally, they're both 29s. Nothing more than that there. Okay. Remember, one of the slide at the front of the presentation, I said what I call a primary cycle is a primary cycle, and what makes it a primary cycle is that its runtime is 4 years or 208 weeks. And so if I'm looking at a set of waves that I construe and define to be primary, there should be 8 of them in that 4-year or 208-week period. And as such, the average runtime for each of the 8 waves, more or less roughly, and I'm being very averaging here in this arithmetic, 26 weeks. If I'm looking at the intermediate degree of observation of a set of waves, there would be 34 waves, and as such, the average runtime for each of those waves could be expected to be plus or minus 6 weeks. If I'm looking at the scale of what I call minor degree of waves, there are 144 minor, so-called minor waves. What makes a minor wave is because in this 4-year period or 208-week span, I expect 144 waves to play out. As such, the averaging, that would be each one of those waves would on average last about 1.5 weeks or just under 1.5 weeks. Or in terms of days, that's 9.8 or 10 days, rounded up. So what did I do? I looked at this daily chart of the bond market and I counted, and I just, wave 1, this move from this bottom here at the end of April or beginning of May, whatever that date is, I forgot the date. I counted. In wave 1, there are 14 days. That's impulsive wave 1. Correction 2, from the move from the top down to the bottom, there are 6 days. Wave 3, the impulsive wave, 16 days. Wave 4, the move from the top at 3 down to the bottom at 4, lasted 5 days. Wave 5 lasted 11 days. So the entirety from the bottom, the set of 5 waves in the bull portion cycle, a portion of the cycle, lasted a total of 52 days. So if I've got 5 of them, I took the average run time, 10.4 days. That's interesting. Closely correlates, not exact, it's close, 10.4, just almost 10.5 days, very close to the average amount of time that the minor set of waves in a minor would last, 9.8 days. 1.4 a week is 7 days. If they're 208, that's how I get just under 10 days. So what I didn't indicate it, but I know it, so I'll mention it, make it explicit. This top here came in on the date of July 11, 7/11. I forgot to put the date there, but that's the date. That's an important point. The top The highest price you see on this screen is on July 11. If there should be 3 waves in that, the A, the B, and the C of the final cycle, completing the set of 8 waves, and on average each one is, say, 10 days, that's 30 days from July 11, which brings you to August 10th. So that gives me a sense. Now, it does notice August 10th is not, I would have loved to sit here. I can't torture the data, folks. I would have loved to tell you that August 10th was exactly 7:29, my next projected time point. You know, figure August 1st. I'm off by, what is that, 12 days or so, 12, 13 days, whatever. But it's close. I'm in the ballpark. And now, first of all, these are just averages. So there's nowhere is it written in any theoretical component of Elliott or any other model I'm aware that each wave must be perfectly symmetric from a price or a time standpoint. But essentially what I'm saying, on average, you would expect the 3 waves to form. If each of these waves can be expected on average to be about 10 days, let's say, and as such, if this is the starting point, July 11th up at the top at the point of end of 5, you'd expect another 30 days of price action given the 3 waves, one way or the other. One wave might be 6 days, the other would be 14 days, the other might balance out. But on average, we would expect a runtime roughly about 30 days in order to make a complete set of 8 waves constituting a complete cycle. So that gets me in the ballpark. August 10th is the actual amount of 30 if each of these waves lasted. So that gives me, more conservatively, if we only run for the next 2 weeks according to the same regime, conservatively I would expect the current price action to persist, assume on that line of reasoning with the expected amount of runtime. And as such, I have greater confidence than if I simply come up with a price target. I have some indication based on the average historical tendencies and average runtimes for each of the waves, and recognizing at a given point in the cycle where the market is, July 11th corresponding to the end of a 5th, what type of price action should occur, and in adding to that the average runs based on historical breakdown that I've seen here, how long I might expect a given move to last. Then you might have, let's say that would occur. Let's say the market keeps running down for the next 2 weeks into this, and 2 weeks from yesterday. Then I might expect the formation of a B wave, taking the market to some higher level. You could trade, if you're a shorter term horizon trader, you could go long, or maybe not. You might get out of your shorts and then wait for the advent of a C wave, taking us down. This is, okay. Well, I forgot to mention this, number 4, the level of the horizontal parallel line here. On typically, another tentative Elliott wave is that ABC corrections somewhere 10 to 70% of the time end up bounded between the preceding wave 3 and 4. So this is this line down here at 165 and let's say 20 something, I'm interpolating as best I can, 165, between 160, let's say 166. We're trading at 171 and 21 we closed yesterday in the 30-year Treasury bond market, okay? So if we achieve the more conservative target at 170.5, and depending on how the market responds, and especially to the extent we are approximating that price at that time point, and watching to see a reversal, this time further out into, by the end of August, it might either correspond to the end of the B wave, or possibly, depending on how fast the market moves, figuring on average 10 days per wave, let's just say. So if we've traveled 1, 2, 3, 4, 5, maybe we've got another 5 days for which we would expect declining prices. Will it reach this conservative target by then? Well, that remains to be seen. But with each candle or bar that's traced out on your screen, you get a finer sense as to the rotations and how they occur with respect to the time points. Let's see. All right. Folks, that concludes today's presentation. I have a few minutes for questions, but again, if you have more detailed questions that in the next final minutes I won't have an opportunity to address to the extent I would like, again, you can reach us at 1-800-339-8588. From time to time, they have discounts, as you see. You can also access the website, www.pacifictradingacademy.com. Peter Newman handles all of any questions concerning this. Dow all-time, yeah, certainly. Thank you, Mike, for confirming that. I know the Dow, I knew the Dow and the S&P at all-time high. I just wasn't certain about the NASDAQ. But thank you for that input, Dow, and confirming that. Yeah, technically, I didn't elaborate it on the stock market, but technically there are reasons why, based on the wave count. Also, my time point, I expect stock prices to surge. I'm not saying unabated. We are considerably, as a result of, especially what the last 6 days in a row, we went higher. So I think yesterday we started a little bit of a pullback, but we're a little overbought. So I wouldn't be surprised for a little pullback. But more or less, I expect the net trend between now and August 1st, or at least the first week in August, the translation or higher prices still. And how and why and the forces ultimately at the end of the day that we can attribute and are responsible to that, a combination of things. I first and foremost start with the charts and combine my price and time analysis to kind of give me a keener sense as to what I think are the higher probability types of price action we can see, to the extent that creates a sense of my thinking for events that I would hear about fundamentally that can unfold moment by moment, day by day. I believe I'm putting together a higher probability possible entry for a value area in a market, and as such it constitutes the beginnings of what could be a good profitable campaign and a trade. Yeah, so ultimately my forecast for bonds is the nominal bond price I expect at least for the next 5 days to continue to decline. My minimum target, about one per conservative price target on the downside, 170.16. And that 16 refers to 30 seconds, 30 seconds. If one is short, great, stay in your short positions as a general kind of thought and consistent with my prognosis, my projection. But I think we are in the bear phase and expect a continued offering down of nominal bond prices. And I've given hopefully some reasons as to why, both from a time and price perspective. And then adding to that, even whether or not we see a rate hike, obviously interest rates are inversely related to nominal or treasury prices. So if we see it, that would be another driver that would serve it. But even if we don't, or if it's delayed, I still, for the reasons that I've just outlined, suggest or indicate and project lower nominal treasury prices. Let's see, any other questions, folks, before I wrap up for the day? Again, if there's any part of the presentation today you'd like to review, we have recorded, and you can archive the recording on the website, pacifictradingacademy.com. To the extent you have further questions that maybe you don't think of at the moment, contact Peter Newman and he'll handle all of these things. Well, very good. Thank you, Steph. Thank you for your thanks. I appreciate it. I always like to be here. Again, the world is constantly changing, and no shortage of events is serving to impute volatility into the financial markets. Some events are not pleasant, obviously, but the consequences and the energy that both positive and negative of all type, a whole spectrum of events as they unfold in our day-to-day existence, constantly, thank heavens, I guess, provide tremendous ongoing consistent opportunities for profits in the markets. So it behooves us to do what we can to kind of be on the lookout for them and have a set of skills and tools that sets us up analytically to exploit them. So I appreciate your showing up and being a recipient of some of my recent ideas. Great. Oh, it's not, thank you guys. I love it. It's not, I don't even consider it work, but it's a pleasure that hopefully you guys get something out of it. That's good enough reward for me. Okay, guys, call it a day, and wish you a great weekend and profitable trading in the days and weeks to come. Until next time, have a great one. Bye-bye.